Good morning, traders. Welcome to the Flow Show. Another week. Might be seeing a bit of summer kicking in now. Hope you're doing well. Good morning to Kay. Good morning to Stel. A happy birthday to Stel. He's 85 today.
Thank you. Good morning.
85 going on 42. Happy birthday.
Thank you, guys.
Yeah, happy birthday, mate. What did you get? Nice cake and tea in bed this morning?
Oh, a new surfboard.
Tea in the middle of the summer. Are you kidding me? This is
iced tea.
I did get some cake actually. My lovely wife prepared something.
Nice.
It was fun, yeah. And we're going out tonight with just the wife and kids to a really nice place, which is by the seaside here. So it's lovely. Very nice.
Very nice. Very nice. Hope you enjoy it, mate. Hope you enjoy your day.
Yeah, thanks, mate.
No worries. Right. How you doing, Kay? You had a good weekend? Enjoyed the weather?
Well, we had our first dry day in how many?
Yeah,
so
2 weeks.
yesterday was all right, yeah. So yeah, ready to attack another big week, yeah, the next biggest week after the prior one. But let's hope the weather stays a little bit better, huh?
Yeah, weird. I managed to get sunburnt yesterday. In the few times you actually saw the sun, we were out in a big park, so that was fun. But yeah, got a bit of shine on the old bonds this morning. So, yeah, that'd probably be it. Winter. Anyway, right, let's get into it. The BOJ had their summary of opinions, which is a bit more cut. Well, I wouldn't say colour. It's like a repeat of their minutes and whatever. Not a lot of difference in the comments from those guys. But one member said that they saw inflation hitting stably the 2% target seems to be in sight. So one member saying that. The rest, as I say, just a bit of a repeat from the minutes we got last week. Not too much coming out on the headline front. We did so. We'll take a quick look at some of the data that came out this morning. If I get to that here. So we got Germany industrial production out this morning. Oh, where is it? There we go. Looking a bit soggy, minus 1.5% month on month, worse than expected, minus 0.5% year on year, also coming in worse than expected there. So not looking too good. Now, German bonds have been rising today because the central bank, Bundesbank, have scrapped interest on government-held deposits. So government-held deposits now get zero, nada, nothing for parking up at the bank. So that's sort of a little bit of a move in German yields. Coming over to the UK, BOE's Peel said that there's a greater risk that inflation will persist in the UK. Going to be a couple of weeks until we get the next CPI report from the UK. He did say UK rates are now in restrictive territory, and it's possible we do too much on raising rates. Always the reluctant hiker is our Bank of England. Coming over to some of the data from last week, obviously jobs numbers was the main feature, and another pretty solid report from the US. 187k was the number there for the NFP, a little less than the 200k expected, but still pretty solid. The month before was revised down, I think it was 209k to 185k as well. Unemployment rate dipped to 3.5%, was expected to remain unchanged. So that was a real move down because the participation rate stayed unchanged. Wages were a little hotter than expected, matching last month's 4.4%, but not dipping to the 4.2% expected. So that keeps a little bit of inflationary pressure in the pipe for the Fed. As you can see, the month-on-month hourly earnings also beating expectations by a pip there. While wages running at 4.4%, that won't be too much of a worry for the Fed. If it starts creeping up above the 5% mark, then the Fed might start looking at that a bit closely. So altogether, the numbers weren't that bad. It shows that the jobs market is still solid. It's not tipping over just yet. But you wouldn't know that from the market moves we got last week, which were pretty wild to say the least. I think what we saw was a bit of a summer washout. You know, we've had these 2 big weeks of events, Feds, other central banks, the end of rate hikes, so on and so forth, and now the final big piece of data. So I think what we did see last week was a little bit of a washout of positions maybe going into the summer period, but we'll take a look at that in closer detail. On the Canadian side, a little dip in the employment, was down 6.4k. Minor moves in the full-time, part-time numbers, still part-time gaining 1.7k, part-time losing there. So still the trend in favour of the full-time there, but bit of a slowdown in the market there. Unemployment rate did rise to 5.5%. Again, participation rate coming in as expected, so dipping a tiny bit. But overall, nothing really to take from that Canadian report. Further on from that, we had the IV PMI later on, which showed that it moved into contraction. Was expected to rise 52.7, came in at 48.6. So yet another PMI moving negatively as well. The Fed heads were out. Fed's Bostic said that the Fed is likely to be in restrictive territory well into 2024. Fed's Goolsbee, right after the jobs report, said that July jobs report is pretty much as expected. The jobs market is cooling a bit, but still extremely strong. Fed's Bowman later on said that she saw that more rate hikes will likely be needed, so still remaining on the hawkish side. And just this morning, Fed's Williams says rates may come down next year, and on the question of another rate increase, says it was an open question, and then repeated that rates could fall next year. What did you make of the jobs data, guys, and the market reaction? Bit of a strange one, if compared to the data, really.
Yeah, sorry.
Go ahead.
So we saw Friday, which was kind of a reversal of the. So yields were rising all the way into the payrolls for the whole week, and then and the dollar as well, and then we saw a reversal on Friday. I mean, the data itself wasn't really anything massively surprising. Yes, okay, it was a little bit weaker than expected, but then again, like you said, the jobs, the wage growth data was a bit stronger than expected. So overall, I wouldn't call the data surprising in any way. I think, actually, I don't know what I think. I still, my core view remains that we are really, really close, or should be at the top in rates, in yields, somewhere around here. Of course, the big level is 4.33 in the 10-year US, but I currently do not see a scenario where inflation is going to start to rise significantly, which for me is the only scenario where yields will be rising. I don't see with central banks at a pause, basically, pretty much all of them, or almost all of them, and with inflation not rising yet. If anything, the trajectory is still lower. I don't see why yields should go higher, apart from some kind of a credit event, and even in that case, if we get a black swan event or some kind of market panic, bonds are the first to be bid. So I struggle to see a scenario where yields go higher. So for me, I remain of the same opinion that yields should be heading lower until the whole scenario changes, and by that I mean at least for the next 6 months. I don't see how this is going to change. So, but to explain Friday's moves, I don't know. Who the hell knows?
Maybe Kay does. Kay, what do you think?
Of course, I know everything. I mean, my second name is Harry Hindsight. In hindsight, we can explain everything. No, I think it's again, it's if you look at the moves, and if you look at the moves we had straight away, the yields have been coming off. There was not much to support them either from the Treasury side on Friday. Pre-weekend profit taking or pre-weekend book managing We've seen the same in the equity markets. If you look at the US, the S&P, ran up to 40, 45, 40, and then dumped again in the last hours or so of the Friday trading. It's really this looks to me like a short-term market at work, not like any major long-termers involved. Otherwise, the moves would be could be volatile, but more sustainable, and we wouldn't be in such a washing machine and a rinse and repeat scenarios. Of course, the Friday liquidity drove it a bit faster and further. But basically, if you look back at the currencies, we are confirming ranges, and we are confirming different sensitivity to what's happening in perhaps oil in China and whatever, if you look at the antipodians. But to me, not a lot has really changed with this report. It's still a pretty decent report if you look at it. The old accepted level of job creation or deterioration or labor market expansion or contraction of 200K doesn't seem to work anymore. It's more like closer to 100 or so. So if you look at the report in taking that into account, it's actually a pretty decent report if you look at the US report. The Canadian one, well, I mean, you just have to look at how the Canada moves. It's still under pressure, the Canadian dollar, which we've seen before. It's likely helped by that test in the WTI above 83 and a failure to keep it under control or to keep it offered. But then if you look at it via the crosses, it's just not doing more than what the other dollars are doing. So the Canadian crosses are not doing any worse. I would still say that dollar Canada is relatively big for as long as it's above 100. It's above 133, 133.40 now. Okay. That about those labor reports. About that BOJ report, if I may, for a second, I'm a little surprised that JGB yields are not higher this morning, because those minutes, they show a central bank which is where members are starting to express different opinions, but all those different opinions go into the direction of a central bank that may be on the move. So I'm a little surprised that even a few BPs, I'm a little surprised that the JGB yields are not a little higher today, like just hanging around at 65. We're still in the 62. So I thought after that report we would have seen a little push just up to those latest highs. I still think we are gradually going to move towards small higher levels there. I don't see too much of a reason for it to come off again, unless Japanese economic data deteriorate very fast. So that's about it. Yeah. I think we're in ranges. I think the dollar isn't dead yet. The rest isn't either. I still see European data, especially out of Germany, being weak. So I'm not a big fan of the euro. That's rather my base ideas right now.
Yeah, thank you very much, mate. Yeah, I agree with that. I mean, if you just take something like dollar yen as an example, we've got a bit of a washout. 141, 140, 190, 142s was sort of my level, was to see whether we're going to get something more than staying in a range. We broke that, but we haven't managed to hold it, and now we're back above it. So I think it looks like we had a little bit of a washout in a lot of pairs, a lot of markets on Friday. So it could have been weekend squaring or just summer squaring, whatever. But the fact that we've had a fairly solid bounce back above the levels now suggests that this was just a bit of a fake out move, and you can see the same in a lot of pairs, and we'll look at those in a bit more detail. But this week can often be a bit quiet. Where am I going? Let's get the calendar up. The week after the NFP can often be a bit quiet. But Thursday, we do get US CPI, which will be the first July numbers. So we need to keep an eye on those. CPI is expected to rise to 3.3% from 3% previously. That's the headline number. The core is expected to come down a pip, I think to 4.7% from 4.8%. So that's going to be the number to look at this week. Do get a few other bits and pieces to keep an eye on as well. Wholesale inventories. I'm keeping a closer eye on inventories right now, because that is something that we could see faltering. It could mean that we're getting some inactivity. We've had various different bits and pieces coming out, stories, headlines, whatever, about the economy, like firms turning down more people for loans, credit tightening, that sort of thing, and just little bits and pieces where we might get indications that activity is going to be slowing. Obviously nothing that showed up in the Q2 numbers as we saw. But something like inventories, I've been keeping an eye on, particularly in the PMIs, because if firms are drawing down on inventories, it means they're not ordering more. They rather go through stock than keep inventory levels high and keep ordering as they produce. So if inventories drop, it can have a knock-on effect if people are using stocks rather than buying new stocks. So there's different numbers coming out that may confirm or deny those thoughts about what's happening with activity. It is a bit of a lagging indicator. So if you see a drop now, it means that activity may drop, in a couple of months ahead. So that's one thing I'm going to be looking for this week. China CPI and PPI on Wednesday. Keep half an eye on that one. Inflation is very low in China. It's expected to come in at flat on that report there. So there's little inflation in China at the moment. So I'm going to be watching that in case there's a bit of a pickup. I don't expect there to be one or any significant one, because the economy is struggling a bit over there. But keep an eye on that one. It could even go into a negative number, which if it does, that could prompt officials, the PBOC, to start hitting a bit more harder with the stimulus measures. So we'll be keeping an eye on that one. Friday, we've got some GDP data, the first Q2 numbers from the UK, as well as some industrial production. So we'll keep an eye on that. A bit of French CPI. I'm not sure if that's flash or final numbers from those guys there. And then we get the Michigan on Friday. But other than that, a fairly quiet week on the data front. We are entering the summer period, so a lot of governments are going to be on recess and that sort of thing, so things might be quieting up a bit. Volatility wise, I'm keeping an eye on that as well. Seeing vols just edging down a little bit. Let me just get those up for you so we can see that. If I can go into the right place, give me a second. Right, so there we go. This you can access via the ForexAnalytix platform, these vol numbers here. What I look at is this 1 month at the money options as a rough gauge. Anything 7-8% or above, like we're seeing in dollar yen, means that prices can move around a bit faster. You're going to see bigger ranges over data points, that sort of thing. Below 6%, things are getting much quieter. So you can see a pair like euro sterling 5.33. We know it's a lower volatility pair, but if you start seeing some of the majors, particularly euro dollar, getting below 6%, it means we're probably going to be seeing some very quiet periods in between data points and headlines and that sort of thing. I'm not expecting vols to collapse too much. We still have got a war on the European continent, and that might have some events stepping up. There were reports from Ukraine, special services intelligence, that Russia and Belarus might be planning a false flag operation at a Belarusian oil refinery to blame on the Ukraine to bring Belarus into the war as well. So we have this risk hanging over us. I'm not expecting volatility to drop back too far. We, before COVID and whatnot, we were seeing vols down in the 4% for something like euro dollar, and it was moving 20 pips a day. So hopefully we don't get down there, but I'll keep an eye on these vols just to see how things are trading. It gives me an idea what to expect from a market, what to expect if I trade these pairs. You know, with vols at 6.6%, I wouldn't be trading euro dollar looking for 300 pip moves, that sort of thing. But it also helps you take advantage if you do get a big move among low volatility periods. You need to know to take advantage of that if you're taking a profit, or if you've been waiting for a level. That's another way to take advantage of the vols in that. You seen anything this week you want to pencil or highlight as far as the data goes? Not a lot out, is there really?
Well, CPI is the big one.
Yeah.
And apart from that, not that much actually. But I have to say, the expectation from what I saw for CPI year on year is to go up from 3% to 3.3. I'd love to see what they're basing it on, because hold on a second. Okay. Because, okay, we have oil, which is rising, but that surely takes some time to feed through to the price of goods and services. And, there is a lag. And also, yes, it's rising, but, I was looking at the chart, the weekly chart, we're back to where we were in April in terms of price. So we are ranging, but we are obviously at the top side of the range. But I don't see how inflation is going to be ticking up. But of course, these economists, they have these models which are supposed to be very clever. I will take the under on that, and I will actually be surprised and not surprised if it doesn't rise at all, and even if we see a 2 handle on the year-on-year CPI. But that's the main event, and it's very, very important. I know we keep saying this every month, but the Fed is looking at inflation, and inflation has always been the problem, and that's why they've been tightening like crazy. So if inflation does start ticking up, then that's going to be a worry for sure for the Fed. But I still have my base scenario being that it doesn't yet, and I think we're going to see it trickle a little bit lower than the last print. But let's see.
There's one reason why CPI will go up, and it's nothing scientific. It's purely the fact that it's done nothing but come down since last year. You can see there. So, as we know, nothing moves in one way forever. Even when we were rising, you saw times when CPI dipped when perhaps you thought it might continue going higher. So it has been coming down for the best part of a year, well, over a year now. And quite significantly, it's picked up in the last few months. So I wouldn't be surprised to see a bounce. Just as if you were looking at a chart of euro dollar that had just had a big fall, you'd expect some sort of bounce. I'm naturally expecting a bit of a bounce, or not naturally expecting, I would say I wouldn't be surprised to see a bit of a bounce. The question is it more than expected? Is it more than the 3.3% expected? Is it going to mark a bottom for inflation? It's fine bouncing 1 month. What if it bounces next month, and the month after that, and the month after that? This is what central banks are scared of right now. They're scared as to whether they've got to the end of their inflation cycle. But a few of them, including the Fed, have been talking about the potential for inflation to bounce a bit. So the market is unlikely to react if we do see a bounce this month, but get a bounce next month and the month after, we might be in a different story, and you're going to see those rate expectations coming back in again. So we have to watch the clock. It's going to be a drawn-out process, I think.
I guess the pace of drop, like the chart you're showing there, I mean, the last 5 months, it's been pretty steep, right? The way we've gone from 6% to 3%. So I guess I get it. It cannot go in a straight line. Maybe there's a little bounce. The question is, what kind of a bounce and how long does it last? So you're spot on, I think. I will always take the under on these inflation prints, at least for now.
Yeah, that's fine, mate. Take 2 to make a market. Or could take 3. What do you think, Kay?
I think it's going to be a volatile event, but volatility will be temporary, because it's always what we get versus expectations. If you look at and I don't know if they're completely comparable, but we've seen the European inflation data being sticky. And due to some base effects or whatever happening in Germany as well, and but it could be in the US as well. You know, those inventories coming down. It's the wages not well, have come off a little bit, but still pretty okay. Yeah, I mean, it's just an open play. I think it's always going to be what are we getting versus the expected, and both ends. And I'd argue here that a higher print versus expectations will have more impact this time than slightly lower one, because that is what the markets generally expect, is for inflation to continue to come off. So if we get a surprise higher one, then you're going to see the dollar yields probably respond more, because the market knows that the US Treasury is there to add supply to the bond market, and so I guess that would have the bigger impact on yields and on the dollar. But yeah, it's going to be probably a binary event, but then the market will likely go back to what it was doing before. So that for the US CPI, and why it would be higher, yeah, perhaps just a bit of seasonals maybe. We have seen that the how shall I say, the travel market has been doing pretty well, but on the other hand, shelter has been coming down, so it could have like it could be anywhere compared to expectations for what I am concerned. But I would expect a bigger move on a higher print than on a slightly lower one.
Yeah, no, I think I agree with that. Then we need to know. It's a bit early now, but you need to know what the price is doing. I think going into the event, if the dollar's looking a bit bearish on Thursday, going in, and you get a hotter than expected number, well, it might be something that's worth a bit of a fade. As I say, 1 month isn't going to change the market's expectations of central banks, and then we'll have to wait to see what the other months bring, certainly. So looking at some of the prices, what do I want to look at today? And don't forget, give us your shouts in the comments here if you want to look at anything in particular. I'm going to take a quick look at gold, actually, keeping an eye on this one, because we have knocked around support. We had a bit of a move underneath on Friday, this 1930 zone. It's a bit of a wide one, probably 1930, 1940s even. We had a little bit of a poke under on Friday in a bit of a wash around, but give or take, we're holding the area. I think if we get under 1930s and we hold under 1930s, we start to see it hold under there, so pretty much down to here. We start seeing it hold on here, then we're probably going to be heading down to the low 19s again. But if it does manage to hold on here, there's every chance that we get a move up. Now, whether we can get all the way back up to the 1980s, I don't know. At the moment, it's looking quite bearish in the short term. As you can see, the old pattern, lower highs, lower lows, keeps the bearish play short term in play anyway. But it's going to need, I think, a hold on this 1930 area to see further downside. If we don't get through there, maybe a move back up to 1950s, 1960s, and see what it wants to do there. If we hold that area on a bounce, then I suggest we're going to keep the trend going, and then we see another move down, probably through 1930s thereafter. Oil had a little bit of a mooch up, got above the 82.50, had a little nose poke above, had a little nose poke through 83s, haven't been able to hold it as yet. And now we're breaking back down below 82. So just this, again, short-term moves. You know, we had a bit of resistance into 82s, then we had the break, then we had another break, couldn't hold it. Does this mean we're at the end of the oil rally that we've seen quite strong over the last couple of months? Remains to be seen. I think we need to get back under this line here, 80.50, probably under $80. That'll take some of the pressure off. If we get another move under 79, that won't look good either. So it's still every chance here of properly breaking this 83.50 area. That's got a lot of eyeballs on it. If we manage to do that, then I'm wondering if that could be a bit of a kicker for CAD, because that hasn't really been on the oil train, not not so far as seeing all of this move. You know, it's been a pretty steady move up for the last couple of months. And dollar CAD hasn't really responded to that in the way you would think. You think that CAD would be stronger, but it hasn't. I think it's going to take a break above here to get the CAD back on the oil bus a bit, because, you know, the range has been pretty tight for the last, 7, 8, 9 months. And that's probably a reason why CAD has been off the oil bus, because there's not been any big moves in oil. So if we get a break up here, then the market's probably going to be thinking about, you know, mid to high 90s as a potential target for oil. That might be something that the CAD will take notice of, which will make dollar CAD a bit more tougher getting up to some of these higher levels. I'm still long in this one. I'm going to see if we get a move through 134, which is a bit of a tough nut at the moment. If we get a break through there, then we could be off to the races again, probably up to 135s pretty quickly. But again, what happens in oil might put the brakes on that sort of move, or could even mark a top here at 134 if that oil breaks out. So let's keep an eye on this week as well. Obviously, if something does happen in Russia, Belarus, and particularly to do with oil and anything like that, we're probably going to see a spike up in oil anyway. Euro dollar still holding where it needs to hold. We haven't really had a retest down towards the low 109s even after this pullback from that move on Friday, though it is drifting back quite swiftly, shall we say. Bit of an area here around 109.60, just a bit of a short-term area, just a bit of prior support and resistance going on there. 109.30.40 again will be the level, and then down into the 109s and those moving averages, which are at today's money now a bit higher, I should think, and yet coming in at 109.20s now for the 55 and 100 DMAs. So keep an eye on that as your support area. Still probably supporting this 109 zone as well. The move into 110 didn't last. Got up to 110.40, and then pretty much straight after we found it as resistance again when we broke back down through. So again, that becomes the top side number to beat if we get a move back up again. So I think for now it's really about picking your ranges, seeing where the levels are going to come in. We can see why 110.40 was a bit of an area. We had that back in the end of July. Up there was plenty of resistance, short-term double top there. So you can call this a third top, where we get to 42s, 43s. Close enough for government work, as Dan and Blake would say. As you can see, it was a former support point before we got this breakdown. So that's marked your top, downside 109.40 into the low 109s is going to be your support area. So decent enough range to play on that one. Look for the breaks on that to pick a side and go with. Euro sterling's looking still fairly upbeat. Still trying to build above 86. It's had a couple of moves, then we've had a little nick below. If it holds here now and holds here for a decent period, we're probably going to get a move up back into this zone. Maybe a look up at the 87s, which I would like very much, but whether we can break through there is another matter. But it is looking a bit constructive at the moment. The prior lows not down at 85s, we're not getting close to, which is always a bit of a bullish signal on the price action. So again, we're making higher highs, making higher lows as well, just in the short term. So this has the potential to move up towards that 87 handle, but it does need to hold 86, 86.10 for the moment on that one. Guys, you got anything you're looking at in particular for this week?
Bill, do you want to show something, or should I do?
I need a couple of minutes, guys. I need 2 minutes. Okay.
Okay, no problem.
Yeah, guys.
Don't worry.
Over to you, Kate.
Sorry, I'm just arguing with my kids right now. Give me a second.
Oh, that's always good. Yeah, Gav, it's Euro CAD has broke back above. I don't know if that line's been a bit washed out now.
Where?
Euro CAD.
Which one?
Since we seem to be up and down it quite often now.
Your account is bouncing around. I'll show it. Yeah, okay. You showed already the euro dollar. I think we were in a range, but as I said on Friday in our room, this trend line had to hold, and it tagged it and it held. So that's already good enough. I think we were in a range underside around. Got a bit of like, how you want to call it, triangle or whatever. Support coming in. There's lots of little levels here, but if we get back down below 109.35, we could test this low. But then, do we have enough power to go through this? I'm not 100% sure. That will be decided by whatever happens in the yields and whatever happens in the differentials. We've seen this. That's your booba thing, I guess, Ryan. This setback in or this widening again in EU-US differentials. What was it again you said about the Bundesbank?
Yeah, they're not paying interest on government deposits. They paying zero.
All right. Yeah, so these are the differentials, and I'm always keeping a very close eye on those ones. And it's hard to actually chart them, but you're just looking at zones, and especially a trend line is not really very helpful. But we see that we peaked above. We had this is your Thursday, Friday rally in the euro dollar, and then when it reverses, well, look at your euro dollar where it is. It's still very much the play, those differentials are still very much directing the moves in euro dollar right now, and perhaps euro crosses as well in some way. I wanted to have a look today at what's happening in the S&P. You see, on Friday we had this move higher, back into the retest of this trend line and that broken trend line, and this convergence around 45.40, 45. That's exactly where it capped. So I think this is your marker for the start of this week, on the top side, to see what's going to happen. I think it's really 40, 45. Okay, the trend lines are going to move higher gradually, but I do think that that this is your level here, the one that we saw on Friday around 45.40. Okay. Downside, if we start to get below 44.60, 44.50, if we confirm over, like, let's say CPI or whatever through 44.40, then I think there's going to be a deeper correction. So this is your basically 80, 90 to 100 points to start the week in the S&P. I do think it's going to be rangy until the CPI, unless we get news to break it out. Or unless we get like a very big volatility in the US yields. For the rest, I do think there's this is going to be rangy for now. There's a lot to do and a lot of ink spilled on how those big money market funds are holding money back from going into the equity markets. But I mean, if we take that as at face value, that means that once the yields are going to be high enough, this equity market should actually, because of money perhaps flowing back into it, which are the proceeds of people getting that free cash, like close to 5% here or close to 4% here or 4.25% here. If you get the proceeds of that in the bond markets, then you will likely see this one form a base somewhere. And if the money comes back into it, if there's not enough money, as those articles please to write, the scope for more downside than this or max over here perhaps is going to be limited, right? Okay, I'm going to have a quick look. There's one or two developments here, and that is going to reply to Horatio's question about the Chinese reopening. Whether or not the investors, and I spoke about that already last week or so, whether or not the investors like what they see in China is going to be reflected in dollar CNH, right? For the time being, we have seen this setback that we had here late July, earlier in well, last week actually. But the fact that we bounce means that investors are not on board yet with the big Chinese reopening. Okay, but now we have to look at what happens. If they don't completely trust it, are they going to take dollar China through 720.22? Well, that's the next question. And for the time being, we have to admit that we have to admit that dollar China is hesitant, right? So whether the market buys the China reopening is the next is again the next question. For the time being, they are very cautious on the CNH. The foreign investors, if the foreign investors would be happy about the Chinese reopening, then you would start to break trend lines on the downside, which is not the case. Okay, so that's still the investor is reluctant to buy it, and there's also stimulus coming into the system, which usually weakens the currency. So that that is one. Now, whether they will punish it or believe in it is going to be told whether we break above 722 or whether we break back in the first instance below 710, and then the big one is going to be around 7, as we know. But if you start to break trend lines here, then that means that the investor is probably more on board with the Chinese situation. And I hope, Horatio, that replied to your question. Couple of last ones interesting. Ryan did most of the majors. Makes, we spoke about this. Also have a look at Blake's week ahead video, and people who are in our room, they know how important that level was here in the 1740s, which has been rejected, and they also know how important the level is at 17, which is the broken trend line. So there's your range for the dollar MEX going into this Banxico and Mexican data week. I reckon this week is going to be quite decisive on what the carry traders are going to do. This time, we had last week or last weeks, it was the other side of the carry trade. What are we going to do with the dollar, with the euro, with the yen? This week, I think it's going to be a decider. What are we going to do with the MEX? So for as long as we don't break above here by the end of the week, it's probably going to hang around here then, or break below again. And one that I very frequently trade, and I'm again in a bit of a position. I said this 1910 would be important. We broke above, done some stops, and now we are back below this longer term trend line in the Euromex. And there's your level 1870, 75 for the rest of the week. So you got like pretty much the same kind of magnitude, 1870, 75, 1910 here on the Euromex decisive, and that's going to be where we end up on Friday. This is going to be important, this whole thing. If Euromex can't get higher, that is one of the carry trades that's still in the market as well, together with MEX yen. This is probably going to retest fresh lows. If we start to break above 1910.15, then we're probably going to go higher, okay, higher. Not just a couple of pips. This is going to go probably higher because something in the MEX may have changed. Looking at the clock, this is it for today. Quiet day, I think, today, and I think we'll see gradually the week increase in intensity. For the time being, the dollar looks to be quite okay at the start of this week. So yeah, testing probably top end of dollar range, as I'd say. Back over to you, Ryan.
Thank you very much, mate.
Ryan, I'll take the baton and show stuff tomorrow, okay?
Yeah, no worries, mate. No
Sorry about
problem at all.
today. It was a, well, minor emergency. Let's leave it at that.
Well, they didn't get enough of your birthday cake.
Yeah.
No, they dropped it.
Oh my God, don't say things like that.
Cool. Well, thank you very much, guys. Thank you, everyone, for coming to us for the Flow Show this week. Let's see what we get from the rest of the week. Enjoy your day. Have a great week on the pit front, and we shall see you all bright and breezy tomorrow.
Bye-bye.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.